coming in. I don't want to welcome her. So welcome everyone. We're starting our Investing Made Easy at Any Age webinar, and I want to welcome Ryan Swar. Excuse me. Pardon me. Ryan Swar serves as Vice President, Investment Manager for North Dallas Bank and Trust and Wealth Department, and has been with the bank for 7 years. Mr. Swar graduated from Stephen F. Austin State University in 2015 with a bachelor's in business administration and finance and minor in accounting. While in 2019, while managing multiple duties for NDBT's trust and wealth management team, he became a CFA charter holder. He is born and raised in Carrollton, and Mr. Swar takes pride in being on the NDBT Cares Board, enhancing community experience and NDBT's community initiatives. If Ryan's not at the bank, you're likely to find him hunting, fishing, enjoying the outdoors, or spending time with family. And Ryan, we're really thrilled to have you with us today, and we know your information will be invaluable to us. So thank you for joining our banking webinar series, and I'll kick it over to you. Thank you.
All right. Thank you, Brenda, and thank you for the opportunity for you and your team to allow me to come speak today. So today is Investment 101. So we'll cover 4 questions. So we'll go over what is investing, why should I consider investing, what investments are available and what are the risks, and how do I start? So what is investing? So if you look at the dictionary, it defines it as to commit money in order to earn a financial return or to make use for future benefits or advantages. So really anything you do spending time or money to improve your life or other lives is a form of investing. So going to school is investing, learning a new language, learning a new trade. That's all investing, just like saving for retirement. You're saving for a future goal, for future quality of life. It can be short-term, long-term. It's all about what your goals are, and it's not gambling. So a big thing with investing is know what you're investing in. So how does it work? What are the risks? Can I get out of it if I need the money? Are there any restrictions? So you really have to think of, you have your hard-earned money and you're going to invest it in something. So make sure you know what you're getting into before you make that investment. And along with that, don't let your emotions drive what you're investing in. It's real hard to catch up in what's popular at certain points of time. It gets flashy and everyone wants to follow the crowds, make sure they're not left out. But key thing with investing is make sure you follow your goals. If you get caught up in it, then you may hurt yourself in the long run versus staying focused on what your plan is. So why should I consider it? Well, it assists the path to a comfortable standard of living in retirement, reduces risk and increases the chances of reaching your goals through diversification, and you can take advantage of compounding interest. So a few real life examples that I've experienced being in the investment industry is we had an elderly couple. They retired, they had their nest egg, and they wanted to live the rest of their life out at home and just enjoy life. So once they reach a certain point in their life, they needed full-time care, and that gets expensive, and they wanted to stay in their house. So over a 15-year period, through their investing and planning, they were able to stay in their house, have 24/7 caregivers, and at the end of it, when they passed away, ended up having about the same amount of money when they started that spending as when they passed away. So that's a case where if you set up your plan and invest, it works out in the long run. A case where you can set a plan, but if you don't follow it, is there can be a family looking to retire, and they set their plan. They said, need to stay on this discipline, contribute this much a month, and use certain funds for long-term use, not short-term. So they got caught up in wanting to redecorate their house, remodel, find a different house, do the same thing, and that just meant more and more short-term spending. And they ended up tapping into those savings that they put aside for long-term, and they ended up actually going through all that, and they either had to make the decision of keep working longer or lowering what their current standard of living was. That's where, even though you invest, if you don't stick to your plan, it may not turn out how you expect. But if you stick to your plan, you can take advantage of the compounding interest. So what is compounding interest? So that's interest that is earned on your initial investment and the accumulated interest. So a basic example, saying you invest $100 at 5% interest compounded annually. So little side note, the 5% is just a hypothetical number. Returns vary over a period of time. So this is for sake of the example. So $100 after 1 year at 5%, you have $105. You earn $5 of interest. At the end of year 2, you earn 5% interest on your $100 plus the $5 that you earned the previous year, and you have to be $110.25. So over time, that can build up without you having to make any additional effort. So the more time you spend invested, the greater benefits compounding will be. So at the bottom, there's the formula of how you can compute that interest. And you may also hear it referred to as time money value. So first example, we'll take Jane. She invested $10,000 at age 20 for retirement and expects to earn 5% annually. So by the time she reaches 65, so that's 40 years, that one-time investment of $10,000 would have grown to just under $90,000. So then you take John, who invested $10,000 15 years later than Jane at age 35 for retirement, expects to earn the same amount, but when he reaches 65, that $10,000 grows to $43,000. So that difference of 15 years of when they started ended up costing John $46,000 just from a factor of time. They could have the identical investments, but time was a huge factor that Jane took advantage where John tried to catch up, which we'll see again in example 2. So instead of doing a one-time investment of $10,000, let's look at it from an approach of, okay, what if we do small increments over a period of time? So Jane starts investing $100 per month when she's 20 years old for retirement and expects to earn 5% annually. By the time Jane reaches 65, she'll have contributed $54,000, but her ending balance, because of the compounding interest at 5%, is just over $200,000. And you look at John, he was at $200 a month, so he's trying to catch up by starting later, by contributing $100 more than Jane. At age 35, expects to earn 5% annually. By the time John reaches 65, he'll have to put in $72,000, and his ending balance will be $166,000. So even though John invested more money each month, Jane ended up with more than $36,000 more than John by the time they both reached 65. So again, it's an example of where even though you may be putting in less up front, the longer you do that, the more you can end up with if you stay on your course. So what investments are available? So we'll go over stocks, bonds, and then they can be put into products that are mutual funds and ETFs. So the little triangle is a risk-return triangle. So the more risk you take on is the higher potential return. But the risk is the potential to lose what your investment was. So cash, and cash is pretty much going to stay what it's valued at, and it will earn a little bit, but you're not going to hit the big returns on it. But you know what cash you have in the bank is going to stay there. Then you have bonds, which are a little bit more risky than cash because you're investing in someone else is borrowing your money and they return an interest payment to you, so you can earn a little bit more, but there's a chance that whoever's borrowing your money could default and you lose your original investment. Then stocks, which are the riskiest of the three in that pyramid, have the highest return because you can have the growth of the company, but the company can also go bankrupt or underperform and your initial investment goes down. So getting more into details of stocks and bonds. So stocks are a type of security that gives stockholders a share of ownership in a company. So that's what you see on the news, that you can buy shares of Apple, Microsoft, McDonald's, Procter & Gamble. Those are all publicly traded companies, and a stock is ownership in that company. So what are the benefits of a stock? You have capital appreciation, so that's the company increasing in value, that's their stock price going up. They can pay a dividend, so that they set on a certain frequency that they pay out to the shareholders a certain dollars of cash. You can have the ability to vote and influence the company, so that would be referred to as a proxy. That's where you can have actual control over what decisions are made based off your percent ownership in the company. And having a mix of stocks can lower your risk by having a diversified. So if you had a portfolio, just as an example of, say, Apple and Procter & Gamble, if you have them mixed together, then your outcome is how do they both perform. So if Apple goes up, Procter & Gamble goes down, you take the average, and that's what your performance is, versus if you just had Apple on its own, if Apple goes up, your investment goes up. If Apple goes down, your investment goes down. So if you diversify it, you smooth out those ups and downs. The last benefit of a stock is inflation protection. So as prices keep increasing, those companies also have price increases in money that they make go up, so their stock price in return could go up as a sign of good performance. The risk, though, is the prices fluctuate. So an example of being in a stock that wouldn't work out would be a company called Enron. So in the early 2000s, there was a company called Enron. Stock price was looking real good. Their numbers looked real good. And it turned out they were misreporting their financials and no one knew about it. So overnight, the stock price dropped almost to zero. So everyone that had their investment in Enron lost everything they had. And being in a stock, if that value goes to zero, your investment goes to zero, and there's not a whole lot you can do about it. So stocks are risky, which means that they are a long-term objective. So over time, if there's bumps and downs, like you may have seen this year with the stock market, it's down right now. But over a long-term period, historically, the stock market's gone up. So if you have a long-term horizon, you can ride those ups and downs, and you can accept that risk to have hopefully longer-term increased returns. And it's meant to be a piece of your portfolio. That's where it gets into defining your goals and what's your objectives. Now for bonds, so a bond can be a government, municipality, or corporation that issues a bond. So they'll be referred to as an issuer to raise money from investors willing to lend them money for a certain amount of time. So the issuer will promise to pay a specific rate, that's an interest rate, during the life of the bond and repay the principal to your original investment, face or par value, at maturity. So an example, a company could say, I need to borrow $100,000. In return, I'll pay you 3% for 15 years. And at the end of the 15 years, you get your $100,000 back. And over that 15-year period, you would have been earning 3%. So the types of bonds, you have corporate. So that would be debt issued by companies like Amazon, GE, Apple, Microsoft. And it can break down to investment grade or high yield. So that's where we'll see on the next slide with the risk. They have different credit quality. So it's how strong is that debt that they issued? Is there a chance that the company could go bankrupt? Well, that's higher yield, that's junk bond. There's more risk that you may lose your investment on it. In return for that, you could earn a higher interest rate. Then comparable to corporate bonds, you have municipal bonds, also referred to as munis. There's certain advantages to those that we'll get into on the next slide. And you have U.S. Treasuries. That would be your Series E bonds from the government, I bonds from the government. It's government debt, so it's secure, but they generally pay lower interest rates because there's less risk in it. It goes back to that little triangle. The less risk, the less return potential. So through bonds, higher the risk, the higher the interest rate. So what are the benefits of holding a bond? You can preserve your capital, so that's your initial investment, and you can have predictable income streams. So typically bonds will pay every six months. So if they pay 3% annually, twice a year, you'll get 1.5%. So annually you end up with your 3%. And municipal bonds, they can actually have tax exempt advantages. So if you're in a position where you need to minimize what your tax is to the government, there's benefits to invest in your local municipalities. So you can invest in Texas municipals and actually have a tax advantage. Because of that, you could have lower yields because, again, you're taking on less risk. You get other benefits being tax advantages, so you could get less return. There's no such thing as a free lunch. So everything you're investing in has a cost associated to it. The more risk you take on, the more potential return. If you need something safe, your potential return has to be lower. So the risk of bonds, or you have the credit risk, that the issuer may fail to make the timely payments. You have interest rate risk. So if rates go up, the value of the bond itself could go down. The reason for that is that there could be newer issues offered at a higher rate, so those are more attractive than what your original holding is. You can also go the other way around, though. If interest rates go down, you can have the more attractive investment at a higher rate, so your price of your bond could go up. You have inflation, so bonds are typically a fixed rate. So if inflation increases, your interest rate that you're invested in, it could lose the purchasing power because inflation is higher than what you locked in on your original investment. Liquidity is a risk on bonds. Typically, the market for those isn't as liquid as stocks. You see stocks you can trade by the second through like the New York Stock Exchange, the NASDAQ. As long as there's another willing buyer, you can sell it. If there's a willing seller, you can buy a stock. Bond markets are a little bit different. It can be trickier to find someone else to either buy or sell you a bond. And then you can have call options. So a call option on a bond is whoever the issuer is has an option at a certain point before maturity to exercise their option and actually redeem the bond early. So as far as putting your portfolio together, you actually have to look at if there's a call option, how does that fit into the portfolio? the issuer exercises that option, can I reinvest and stay on the track for what my goal is? But because you're at a disadvantage with that, call options do offer a higher yield, a higher interest rate on them. So again, you're taking on a little bit more risk, so you get a little bit more in return. But you have to plan out for what risks are in your investments and how does that affect what your investment purpose is. So when would you use a bond? If you need recurring income, you have a lower ability to accept risk, so they are less risky than stocks, and longer term horizon. So if you're planning on buying a new car, buying a house, going on vacation with money you have put aside as an investment, if you're in a bond and you're planning on doing this in the next couple months, you may not be able to sell your bond fast enough to meet whatever your goals are. So they're generally longer term, and you stay on track, and then once they mature, you just keep reinvesting to meet your goals. So then we have mutual funds. So mutual funds are popular in 401ks, which we'll talk about in a few minutes. But mutual funds are companies that pool money from many investors and invest the money in securities such as stocks and bonds. So you can have a mutual fund that invests in just stocks, just bonds, or actually a blend. That's where there's a bunch of different types of mutual funds. You can have money markets. So those are investing in very short-term fixed income. So that would be like overnight treasuries, very liquid. You could get your money back next day. They're in same day, but again, being that very short-term, very safe, you have the lower return. You can have stock funds, so that's where they can be in invested in, say, like the S&P or NASDAQ, which are a few phrases that you see often on TV. You hear of the Dow, the S&P, the NASDAQ. So those are three indexes. The Dow is made up of 30 large companies. The S&P is made up of 500 large companies. The NASDAQ's made up of about 3,000 large companies that are primarily technology focused. So the three of those you can use as a general market indicator of what's going on today, what's going on over the last X time period. You can use it as at a glance what's happening in the market. So you can have a stock fund that could be any portion of those, and that can be broken out into broadly three categories. You have value, blend, and growth. So value tilts more towards paying a dividend, looking for things that are fairly priced, could be undervalued. And then you have growth, which is investing based off of future growth expectations. So that would be companies like Netflix, Tesla, Amazon. Everyone's investing in them because they see what could the companies produce? What are they expected to do in the future? Well, they're expected to keep growing, coming out with new technology that can benefit the population. Where on the value side, you would have companies like Pepsi, Coke, Procter & Gamble. You know they're going to stick around. They know what they do. They do it well, and they're not looking to shoot for the moon on something. They're planning on staying where they are and keeping on the same path. You have bond funds, which can have a mix of the corporates, the municipals, the treasuries, and it can spread over three categories. So it can be short term, that can be less than 3 years. You can have intermediate, which is about 3 to 8 years, and you have long term, which is anything greater than 8 years. So using mutual funds, you can have access to more areas of the market at a lower cost. That you're pooling the funds together, you can touch more areas without having as much money to invest initially. Last type is target date funds. So target date funds are built for 401ks, retirement plans, and they're driving off of when does the participant in the 401k turn 65. So if you turn 65 in 2025, they have one fund that will mix equity and fixed incomes, and as you get closer to retirement, it will become more and more conservative. So it helps make the allocations for you, with you either not wanting to put in the extra time of I got to keep changing my allocation, or just don't know. It's a mutual fund that's there to help you out if you just need help and you want to keep it simple. The benefits of mutual funds, since you're pulling money together with one company to manage it, you have professional management. You can be more diversified because that one position in the mutual fund could end up holding the entire NASDAQ index. So your one investment gave you exposure to 3,000 companies at a more affordable cost. Liquidity, they trade similar to stock, except they only price at night. So if you place your trade at 9 o'clock in the morning or 2 o'clock in the afternoon, you'll get the same price. But you do get your money back the next day as far as placing your trade. There is the risk that it fluctuates, so the value could go down depending on what the investments are made by the mutual fund. So you can have the capital appreciation, but there is the risk that the value will go down. They also pay dividends, so it can be a source of income, or they pay interest if they're a fixed income fund. But things to look at if you're looking at mutual funds in a 401k, 401k provider will probably give you a sheet listing what's the performance of all the funds that you can pick from. And it's real easy to start looking at, well, who has the highest performance. But again, it goes back to what we started talking about, is understand what the investment is. What is that mutual fund invested? Is that something that they said they're going to do? Does a management company say they're going to invest in that? What are the risks of those investments? Does that fit what you're trying to do? So how to use them? Well, you can use them short-term or long-term, since you have the money market mutual funds. Those can be short-term if you just need to park money real quick, or they can be long-term, being like target date funds for 401ks. But they're a good place to get started if you're looking for broad diversification with less money to invest up front. Then ETFs, or exchange traded funds. They haven't been around as long as mutual funds, but they work similar. The difference is, instead of you pulling your money together and then them using to purchase shares of a company, is the ETF managers made a basket already, and you're buying a piece of the basket. The primary difference is when they're traded. So they're traded on national exchanges, just like stocks. So if you go to place your trade, you know right when you place your trade what your price is. Versus mutual funds, it's all trading at end of the day, once the mutual fund can determine what's the value of the mutual fund that day. So ETFs are generally broken down into two types of funds. So you have index-based and actively managed. So index-based, they're low cost because all they do is track an index. Like we talked about, the Dow's an index, the S&P's an index, the NASDAQ's an index. So if you just want to invest in something that's simple, keeps up with the index, then there's an ETF index that would track the S&P. Mutual funds have the same thing as well. And actively managed would be is they're trying to beat the S&P, or they're trying to beat the NASDAQ, or they're geared towards producing a higher dividend. They're actively selecting what stocks or bonds to put into the fund to meet whatever the fund's objective is. So again, you have the benefit of professional management. They generally have lower costs to run the funds than mutual funds, because ETFs are primarily been passively invested, so index-based. There's less administrative work that goes into it, so they can offer it at a lower expense ratio. You can trade them at any time when markets are open. You can get the same diversification like mutual funds. If you're in an index fund, the S&P 500 or NASDAQ, you have the exposure to the entire index, and also you have the liquidity of being able to trade it on the open market. They also have a similar risk, though, as mutual funds and stocks, where the prices can fluctuate throughout the day. And they also have management fees. So the actively managed funds, they may have a good performance record, but it may be very expensive for them to run that. So once you factor in the return plus the cost for them to run it, you could end up having a lower return than just being in a passive index. That again goes back to understanding, what are you investing in? You dig through, okay, this fund says they're going to track the index. Are they really doing it? And is it worth me putting my money into that? So when can you use them? You can have short-term or long-term. Again, depending on what type of fund are you using. That's also a good way to get started, having fewer assets. So using what we've talked about, how do you start? What account types can you use? Retirement versus non-retirement. Finding your goals, creating a plan, defining your risk tolerance. How do you diversify your investments? And then what method suits you? So the account types. On retirement, you can have employer sponsored, which are 401ks. You have individual retirement accounts, commonly seen as IRAs. They can be broken down into traditional and Roth. And you have non-retirement accounts being brokerage. So that would be your E-Trade, TD Ameritrade, Schwab type accounts, and then bank deposits. So the bank deposits are primarily if you need to have a safety net that you need to have, if you need the money fast, you need to know it's there. Bank deposits are one of the most secure places to put it historically. So if you're needing to have an emergency fund, if there's a medical emergency, or you get in a car accident, or something happens at your house, or you want to buy a house, buy a car, you want the money fast, you need to know it's secure and you can have it in something like a CD or savings account at a bank. But traditional 401k, shifting back to retirement accounts. So their retirement savings plan offered through employers. Your contributions can be pre-tax and deducted through the payroll processing. So you elect how much you want to contribute each pay period. There are contribution limits as of 2022. If you're under 50, the most you can put in 1 year is $20,500. If you're over 50, they allow you to invest more, and that's $27,000. Again, that's as of 2022. A benefit of 401ks, employers could have a matching program. So an example is an employer can match 50 cents for every dollar the employee contributes up to a certain percentage. So if you contributed 5% of your paycheck, that turns out to be $5,000. At the end of the year, no matter what you're invested in, the employer could match $2,500 of your investment. And that's a benefit for working for that employer. So when you're looking for a position at a company, like, you look at what your take-home salary is, but also look at what kind of benefits do they offer through their retirement accounts and the 401ks. There could be a way, being a tenured employer, they could increase how much they match over time, and that's a way to have better returns without having to have the exposure to the market. There's no taxes until withdrawals are made, and they're long-term investment horizon. So they are a retirement account. It's not a place to put your money to go on vacation next year. It's a long-term investment. It's for once you finish your working career. So what investment options are in a 401k? So most of them are offered in a fund menu, and the employee selects what funds to allocate their monthly contributions to. So like we talked about earlier, there's target date funds. So it offers a diversified portfolio based on when the investor reaches 65. So that can just be one investment that you're in, and you can set it and forget it, or you don't have to do all the research of what fund is best for me. It's one that looks long-term for you and puts you on the right path. But you can also select any fund mix you want. You can say, well, I have a long time before I retire. I'm just starting out my working career. So you could go all equity. You can ride those ups and downs. But say you're starting out once you're 55. Well, if the market goes down and doesn't recover for another 15 years to get growing again to help you reach retirement, you could run into a problem meeting your goals. So that you may not want all that equity exposure. You want to go into fixed income. So it allows the investor to take investments that align with their own goals and objectives. But there's also pieces of 401k that often get overlooked. They generally have tools to help you select the fund. So they'll go through questionnaires of how much risk can you take, how much risk should you take, and what's the right mix of funds. They can help guide you through the process so you're not on your own. They also have calculators out there that help you figure out how much do I need to retire. That's a tricky question because everyone has a different situation. There's no turnkey answer to apply for everyone. What dollar amount do I need to reach? It all depends on what do you plan on doing in your future life. So then you also have IRA accounts. You have traditional IRAs, you have Roth IRAs. So the difference is traditional IRAs is pre-tax dollars. Money grows tax deferred. Withdrawals are taxed as current income after 59.5 penalty free. You could take money before 59.5, but the rules are in place. If you take before that, it's saying you're not using it for retirement. So you have to pay, in addition to tax, a fee on top of that. But once you reach 59.5, you can draw penalty free. Since you're putting in pre-tax dollars, you have to start taking distributions or withdrawals after the age 72. So these are long-term horizon accounts. But on the other side, you have Roth. You contribute after tax dollars. So it's after you paid your tax. Money grows tax-free. Because you've already paid your taxes, you're not required to make withdrawals during your life. And so it's also a long-term investment horizon. It's still a retirement account, but it's structured of pre-tax versus after-tax. And of when to use on, there's resources all over online that can help figure out, is a traditional better for your situation or Roth? It all depends on what your current financial situation is. Non-retirement accounts. They allow you to buy a variety of investments, so stocks, bonds, mutual funds, ETFs. The big difference, though, is your dividends, interest, capital gains or losses. So capital gains or losses, if the price appreciated, you get taxed on the money you made on your investment. Capital losses are the money you lost. So if the price went down, there's a tax on what was lost, and it's actually a tax benefit since you lost your principal investment, but they are taxable each year. Versus retirement accounts, they're either not taxable using accounts like a Roth, but if they're 401k or traditional IRA, they're not taxed until you take the money out. But there's no contribution or withdrawal limits. It's just like you could compare it to like a checking account. You can put money in wherever you want, you can take money out whenever you want, but there are tax implications. But because of the freedom to put money in or take money out whenever you want, you can use it for short-term, intermediate, or long-term. So once you can see the types of accounts, the types of investments you can be in. So how do you know where to put your money in all those options? So you need to look at what are your goals. So what are things you're trying to save for? Are you trying to save for a house, car, education, comfortable retirement? You want to leave money for your family, you want to help your family out. You want to travel, you want to take vacations. You have to look at what's important for you. So the good way to get started is make a list, decide how much time it will take to reach each goal. And part of making that list is, okay, I have my goals. I need to plan on how do I reach them. So investing is a journey, and to reach your destination, you need a plan or a roadmap. So the map guides you on how much you need to save and when. So to try to get you to your goal. And you can consider what are your needs. So those are your basic things like food, shelter, clothes. Like that's your bare minimum. What are your wants? So that's finding a house closer to family, or getting a bigger house, or buying a new car. It's things that are nice to have, but you don't necessarily need them. Then what are your aspirations? So that's the dream vacation, dream house, or you want to get into a nonprofit, you want to help the community. It's what are your big dreams? What are you trying to reach for? And you can set your goals and create a plan by setting them in those categories. And you can have an investment approach so you're on track to meet each one. In doing that, you have to create a budget. And what's your current financial situation? So figure out what's your income. So how much are you earning versus how much are you spending on your expenses? What are your current assets? And do you have any debt? You have to figure out, do I need to pay off my debt, or do I need to control my spending now so long term I can hit my goals? So that goes back to the very beginning. We talked about, you had the couple that they had their nest egg, they had their plan for saving so they could live the rest of their life out at their own home and live comfortably, and at the end it worked out. And then you had the other couple, they had their plan put in place, but they weren't disciplined, they didn't follow it. Then at the end they had to either go back to work or they had to adjust their lifestyle. So if you have that plan, stay disciplined, it will tell you how much you need to retire comfortably. Comfortably all depends on who you are. Everyone's lives are differently, so no two plans are the same. And there's no one plan that you can just set and just let it go. Like, life happens, so you have to make adjustments over time to make sure you're still on track. Or something could happen and you're like, oh, well, that goal's not as important to me anymore. I'm going to shift over here. This new one just popped up, and it made this goal I had even more important. So it's a living thing. You have to keep it going, keep reviewing it, and make adjustments that are necessary. Once you have your goals, you have your plan, is how much risk can you take? That's your ability to take risks. What's your time horizon? What's your purpose? And can you meet your goals? And how much willingness do you have to take the risk? So that's can you sleep at night? So there's no reason to be invested in something if you're tossing and turning all night long, or you're spending every second during the day checking on what's my investment doing today. That you're just going to cause yourself more stress, and you're not going to hit your goal because you're too worried about tracking what's going up, what's going down. You be able to be comfortable in what you're invested in, and don't overstretch your goals by taking on more risk when that may not be the best case. There's always chances I can adjust, but it's tough to come back if you take too much risk and it takes a dive at the end. But one thing to avoid that is diversification. So don't put all your eggs in one basket. That's a common phrase. So diversification is mixing your investments in a portfolio to reduce your risk. So examples can be mixing a portfolio with 60% equity, 30% fixed income, 10% cash. So we talked about all the varying risk levels and the return levels. So 60% equity, you take on the risk, but you have a higher return. Fixed income, that gives you a little bit of stability and return. 10% cash, that gives you a place where you know it's going to stay steady. So across all three, you can have a good mix. And depending on what your goals are, that range can be any mix you want. This is just an example of what you could do. Another thing you could do, you could say your retirement account's invested in equity. That's long term. You have your emergency funds in a savings account. That's safe and secure. You can get it whenever you need. And then you can supplement your monthly income with bonds or fixed income. So again, it's a mix of everything out there. You're diversified, so you're reducing your risk to meet the returns you're trying to hit. So through all that, what method works for you? So they're self-directed, that's to do it yourself. You can make all the decisions on your own, you can do all your own research. There's nothing wrong with doing that. You can look for an advisor, so that's hiring someone to get you on the right path. They can look at your situation and say, hey, these are the investments that can help you reach your goal. And then the last option is discretionary management. You can find a financial institution that you say, hey, here's my goals, and I need help reaching them. That company can make the investments for you, and they'll meet with you on a periodic basis to make sure you're on track for your financial goals. So to wrap it all up, so understand the investment before putting your money in it. What's the purpose of the investment? Does it help me reach my goals? How can I get my money out of it if I need it? Are there any tax consequences or penalties for exiting the investment? Is it short-term or long-term? Create a plan, put it in action, keep reviewing it. What's going to happen? Take advantage of your employer-sponsored retirement plan. Take advantage of the employer matching if they have it. Look for the tools within it. If you don't know if you have tools or not, go find whoever handles your 401k. Go ask the HR representative. And you can look for professional help. So that's looking for an advisor or discretionary manager. And then just start investing for your goals today. As you saw, the sooner you start, you can take advantage of the compounding interest, and time's on your side then if you're starting soon. So that wraps up what I have. And Brenda, thank you again.
Thank you so much, Ryan. That was so informative. I hope everyone got as much out of it as I did. Does anybody have any questions? We have a few minutes to open up the microphones if anybody wants to ask a question or put into the chat. Ryan will be happy to respond as well. Anybody? Anybody at all? Okay. So I'm going to put a little quick poll out there and go ahead and answer. It's just a yes or no question. It's just a quick, did you find the workshop effective? So far you're at 100%, Ryan. Everybody so far, I've got 3 out of 3. And the 4th person might not be able to get on. So excellent. Everybody found this 100% effective. So I appreciate your time and your effort and your explanation on everything. And anybody who wants any additional information or would like to get in touch with Ryan, please feel free to reach out to me and I can send you his contact information. And if nobody has anything else, we'd just like to say thank you again for joining us today for our bank webinar series at Jewish Family Service. Keep tuned every first and third Thursday of every month. We have different topics. We will have the same topic again in 2 weeks, Investing 101, Investing Made Easy at Any Age. And we look forward to you telling everybody you know about our program, and we look forward to seeing you all soon. Thank you again, Ryan, so much for participating in our program today. We appreciate
Oh,
you.
thanks for having me. And thank you for everyone that joined today.
Everyone have a great afternoon. Thank you so much. Take care. Bye-bye.